Ladies and gentlemen, good day and welcome to Manoj Ceramic H2 FY25 Results Conference Call hosted by Ventura Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touch-tone phone. Please note that this conference is being recorded. Before we begin, I would like to point out that this conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. I would now like to hand over the floor to Mr. Rajneesh from Confideleap Partners. Thank you, and over to you, sir.
Yeah, thank you. And good day, ladies and gentlemen. Rajneesh this side from Confideleap Partners. We represent the investor relation for Manoj Ceramic Limited. On behalf of Ventura Securities and Confideleap Partners, I warmly welcome you all to Manoj Ceramic Limited H2 FY25 earnings conference call. The company is today represented by Mr. Dhruv Rakasia, the Managing Director of the company. I would now like to hand over the call to Mr. Dhruv for his opening remarks. Thank you, and over to you, sir.
Good afternoon, everyone. On behalf of Manoj Ceramic Limited, I warmly welcome you all to our first ever H2 FY25 earnings conference call. It's a privilege to connect with you all and share our journey, progress, and upcoming growth story. Giving a short brief about MCPL's history, we began over 3 decades ago in 1991 as Manoj and Company, which was focused on trading building materials like marble, tiles, and cement. Since then, we have transformed into an internationally recognized design-forward ceramic solution company, specializing in ceramic tiles and adhesive. We steadily evolved and securing dealership tie-ups with major brands till 2007. Later on, started our imports from major countries, expanding into large format imports and establishing a strong presence in Gujarat by 2010. The launch of our Andheri showroom in 2013 marked the start of our retail expansion, followed by flagship centers in Mumbai, Pune, and Bangalore. A significant milestone came in 2021 with the incorporation of Manoj MCPL Ceramic Limited in London, marking our global ambitions. In 2024, our listing on BSE SME platform was another history for us into the capital markets. Our growth has been built on a foundation of innovation, customer focus, and a commitment to quality, reaching homes, commercial spaces, and projects across India and global markets. Looking at our finance performance for H2 FY25, I am pleased to report significant milestones. Revenue surged back to 98.01 crores, a remarkable 84% growth over the previous period. EBITDA stood at 13.51 crore, with stable margins at 13.79%. Profit after tax grew nearly by 3 times to 6.64 crores, a testament to our efficient operations, market traction, and strategic focus. These numbers reflect our ability to scale while maintaining profitability, and we believe this is just the beginning. We are expanding globally with a strong push into key African markets such as Sudan, Angola, Ivory Coast, Senegal, Burundi, and so on and so forth, counting down, while strengthening our presence in Europe and North America through the UK and the upcoming US operations. Simultaneously, our digital transformation division and AI-powered studio, which is available on our website, are driving higher engagement and conversations both online and in-store, enhancing the customer experience and creating a seamless buying journey. Infrastructure upgrades remain a priority. We have launched MCPL's largest display center in Upper Thane, Bhiwandi, spanning over 70,000 square feet, expanded a warehouse facility in Pune and Bhiwandi, and are poised for the next phase with a new Nagpur warehouse and Dubai display center by FY26. Our vision is clear: to emerge as a leading force in the global ceramic industry, delivering innovative designs that reach every wall, every floor, and every decor need, for homes to commercial spaces, both in India and beyond. Our goal is to be the partner of choice for customers worldwide, offering them not just enterprise, but end-to-end solutions that inspire and transform spaces. Before we open the floor for questions, I would like to take a moment to thank our employees, partners, customers, and shareholders for their unwavering support and trust in MCPL. Today, we are building a company that stands for innovation, design, excellence, and a customer-first approach. Once again, thank you very much. Over to the team for the taking up the questions.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your name to be announced. If you would like to withdraw your request, you may do so by pressing star and 1 again. Ladies and gentlemen, if you have any question, please press star and 1 on your telephone keypad. First question comes from Agastya Dave from CAO Capital. Please go ahead.
Am I clearly audible?
Yes, sir.
Yes, sir.
Good afternoon. Thank you very much for the opportunity and congratulations on very good set of numbers. Sir, first question is actually on the business model. I have seen that you have elevated levels of working capital, but very asset-light model on the gross block side. So am I right in concluding that you are purely a marketing company and a trading company rather than a manufacturing company? And will this setup continue going forward as well? You will not enter into manufacturing?
Thank you very much, Agastya. Yes, we are an asset-light company, and we focus on outsourcing our production in the tile division and tile adhesive at the moment. Tomorrow, as the past has given us the instances of the aggressive investments requirement for the massive innovative tiles that have recently come up, we do not see ourselves in getting into backward integration in the tiles manufacturing because of the innovation that is very quickly seen in the very short term in the past 5-7 years. Whereas when we talk about tiles adhesive and the natural stones division that we have recently incorporated, yes, we are looking at the backward integration in that phase. Very soon, its announcements will be coming up.
Understood. And in the tiles space, in that, what is the nature of your fixed assets? Is it, I mean, do you have any front-end investments? Any like experience centers or any like retail presence, or is it?
Yes.
Are the sales done completely through distributor partners?
No, we have two modules in our business. We have the wholesale division, which takes care of the dealers and the projects. And we have the retail presence as well in the West Zone and West and South Zone. We have two experience centers in Mumbai, one in Ghatkopar, the oldest one, which was set up in 1991. And the another one is in Andheri West. It's in Lakshmi Industrial Estate. And the newly experienced center recently, the biggest one that has come up in Upper Thane in Bhiwandi, which is also one of the stock points. In South, we have it in Bangalore, and in North, we have it in Morbi. Morbi is purely a warehousing center, where the production output is stored there, and the multiple factory products are accumulated and again dispatched to various locations. In abroad, we have our retail presence, retail and wholesale presence in London, which was about 1.5-year-old baby. And we are setting up our display center in Dubai, and it will be ready for people's experience by next month.
Right. And so in terms of the product, is there a particular segment that you're targeting in terms of pricing, and any particular type of niche products, or are you catering to a very broad segment?
So we have our product portfolio right from the smallest size of 1 feet by 1 feet up to 10 feet by 5 feet, the biggest range in the industry that we have. We maintain stocks for all the sizes. Every size will have multiple finish. Every finish will have multiple colors to offer. So we have a huge portfolio of product to offer to the end user, as well as to our dealers for selection and the builders. And one-stop solution for tiles.
And so in terms of your margins, what helps you keep the margins at the current level? And given that people have so much, like some of them are sitting with excess capacity, why can't they replicate what you are doing and capture your margins?
So this is an open market. Everybody is welcome. There is no restriction in the new entrants that is coming up. See, it is the experience that has brought into this company in the Manoj Ceramic. My father started it in the year 91. I'm the second generation entrepreneur. So looking at the various market segments, the market requirements, we have kept on improving our product portfolio. And people are scared to take the risk on taking the first step, first leap, because that is always heavy capital requirement. It is a risk whether or not the product will move, and it is the experience that whether this product will move. So when we have in combination of experience and the technology and the new innovation and the new youth who is ready to run in the required market, there can be magic in numbers.
Understood. And so one more clarification on, again, the business model. So in terms of pricing, so what exactly happens here? You get like a discount from the OEMs, and then you sell at the MRP, which matches them? Or because you are present in areas where the other people are not present, so you buy OEMs from the OEMs at market price, and then you sell at a premium. What exactly happens? What's the equation there?
We get a better pricing than an end user or a project person who visits the factory because of our volumes and continuous relations with the manufacturer. And we sell it adding our margins to the end users or the project people because of the service that we offer. We maintain the stocks at our warehouses, and whatever quantum is required for the end user, maybe if you come down to the store and you require only one bathroom of product, then of course they will be supplying from our current stock points. So the pricing will be higher compared to the person that I'll be offering the product for the entire project, which will come directly from the factory. The dispatch will be from the factory till their site, but they will be giving them better prices. But yes, definitely our margins are added up after the manufacturer's pricing to us. But it will be definitely lower than the project person visiting the factory directly.
Understood. And this is true in the case of your B2C sales as well?
Yes. So B2C usually happens from our retail stores. And in that case, the margins are much higher and the pricing is much at its peak when it gets directly to the end user from our retail stores. Because the pricing is in competition with the other dealers that we supply. We do not undercut our margins and sell directly to end users from our retail stores, else my dealers will be affected, which we do not want. So our pricing competition from the retail store is exactly in competition to our dealer's retail store.
Understood, sir. So my final question, I have many questions, but I'll go back in the queue after this one. Sir, if I look at the growth this year, you delivered quite a lot of growth in the top line, but your employee costs didn't go up that much. Now, going forward, how will this parameter change with I'm pretty sure you have some healthy growth expectations. So first of all, how is the growth looking like for the next, let's say, 2 to 3 years? And second, what happens to your employee cost and your, I mean, I went through the line items in the annual report, and I saw rent is the biggest component of your other expenses. So I'm guessing this is like warehouse rent as well as your front-end car rent. So how will this also grow as you increase your turnover?
See, as and when we are at the current stores, we generally usually take about 8 months to 12 months for the new stores break-even to come down. 8 months to 12 months for the break-even to come down. Till that time, the burden per store or per unit is always higher. After that, the profitability start to move in from that particular unit. So, and we are still in the growing phase, we still want to capture bigger markets, and from our wholesale units, wherever we put up our new depot. So for the next around a year, we are inculcated to service that from the accruals that we currently have. So and we talk about expansion. Yes, we are looking at further expansions into many new states in India as well as in abroad. We are focusing on exports exponentially. We have set up a new division and new team around December, focusing only on the export market, which can get us volumes as well as margins. Retail presence is required only for the purpose of better margins and an experience center for an entire range of our products. And wholesale, the dealer distribution model requires a unit setup for catering to the periphery of about 250 radius kilometers to service our dealers from that particular store. So we need to have all the divisions have to work individually to contribute for the betterment of the company.
Understood, sir. Understood. And on the employee expenses side, how will they increase, sir?
So it won't increase exponentially compared to the top lines because the existing stores have started to get better compared to previous years. And the customer base have started to trust more on the brand even after the SME listing, because they understand that this is a systematic, organized company and it is compliant free. So it is better to trust the people who have a good backup of servicing later on. So the trust element gets better and brand presence gets better. So the expenses tomorrow can curtail down and the top lines can get more higher.
Understood, sir. Sir, I have 3 other questions, but I'll go back in the queue and come back with them later.
Sure. Thank you so much.
Thank you. The next question comes from Gunitsan from Counter Cyclical Investment PMS. Please go ahead.
Hi, sir. So firstly, what percentage of sales comes from our own brand?
So majorly it is MCPL. That is a service-backed product. So over 90% of the product sales happen from the MCPL product portfolio. Rest 10% comes from the brands like which helps me contribute, which is Kajaria or Emser or the outsourcing product that we distribute their product into.
All right. So majorly we are selling under our own brand. So
Yes,
what gives us the confidence to grow 25 to 30%, whereas the large players in this segment, they have been stagnant and they have been guiding stagnancy or maybe low single-digit growth for the coming 2-3 years, even the market leaders. So what gives us the confidence?
See, it is easier for a smaller company to double up its top lines considering the market share, whereas bigger players who already are the market leaders cannot double up their sales, irrespective of horizontality or vertical expansions. So, and when we talk about MCPL, we are just present in the west and south zone yet. And our expansion levels, only considering India, is we have the rest of entire India, which is empty, which is not yet catered with MCPL and its logistic network. Our focus is completely on retail-based sales. Retail-based sales as in people who require smaller quantum of product. Maybe a dealer who require 50 square meters or 100 square meters. We service only 50 or 100 square meters orders, which is better, which gives me volumes as well as better margin compared to a strong brand player tying up with government with bigger volumes and less margins.
All right. So what percentage of sales are B2B and B2C?
So we talk about tiles division and overall domestic contributes about 95% of the entire sales portfolio, 95 to 98%. And when we talk about dealer network contributes about 90% of total sales, and followed by the retail stores, followed by projects.
And I mean, what portion of this is B2B sales and
So B2B is dealer networking. So B2B is dealer networking, which is 90%.
All right, sir. Got it. So, I mean, do we have any plans to get into production in the future? And also, I mean, the numbers look very good to be true, because even backward integrated companies are giving margins of about 8 to 9% right now, whereas we are at about 14%. So, I mean, even though the previous participant asked the same question, I mean, can you throw some light on why we are generating such margins, whereas even Somani or Kajaria, they are not able to generate, I mean, such margins in the tiles business? So, I mean, what differentiates us from them, and how can we sustain these margins if we grow scale? I mean, when we grow scale, we would definitely be getting into lower margin projects with higher volumes. So, I mean, will we be able to maintain these margins?
So it's a good question, and officially, and previously also I was raised with the same question. See, for that we need to understand the industry. In the past 5-7 years, the industry overall, tiles manufacturing industry, has grown exponentially, considering after the COVID regions, the export throughout the world has got better compared to we have started to capture Chinese suppliers market, and geographical also we have a better position in the world in catering to the Middle East, Africa and the West compared to the Chinese manufacturers. And we talk about China in particular because they are the market leaders in volume and production consumption in tiles compared to anyone in the world. For example, if we have about 1,000 manufacturers, they will have about 5,000 manufacturers only for tiles. Talking about backward integration for tiles and comparison between MCPL as a contract manufacturer and a whole-time manufacturer, Kajaria or Somani. Recently, due to the Make in India concept, the tiles industry overall has got better in production. After Brexit, Italians were forced to sell their technologies other than selling their only the finished goods. So Indians were one of the first ones to grab that technology. And before COVID, the technological products got better. Indian manufacturing products got better in tiles industry. And after COVID, we had the number of advanced players for better quality products got improved. Previously, it was just 4 or 5 of them who got a better technology. Today, out of 1,500 have got a better technological advanced product today in supplying. When you talk about advancing your technological products means requires a lot of heavy investments for the manufacturer to turn around their product quality, to turn around their product colors or quality in offering to the market, to the end user. Whereas, so they have to heavily keep on investing for improving their production capacities, production qualities. When it comes to MCPL as a contract manufacturer, today if, for example, factory A is manufacturing the latest product and we are already buying from the factory A. Tomorrow, if factory C comes into the picture with a better advanced technology, which gives a similar size of product. MCPL just has to tie up for the required market, give them the required volumes, and start distribution without any heavy investments, without any heavy deposits or heavy anything of that sort. Whereas A's market will have to go to tier 2 and tier 3 markets only, because the fastest growing cities will start adopting newer technological products. That will enhance the margins as well tomorrow. So MCPL has a better future than a direct manufacturer, because as and when the new technological product that comes into the market, MCPL just has to grab that opportunity, tie up with the new manufacturer and start distributing. So the turnover time and the turnaround time, being asset light, can be faster. The figures can improve on a better scale, on the top lines as well as in the bottom lines. So that is what we have always been doing. Talking about my backward integration, so our company's backward integration into tiles, currently it is not the stage wherein I am looking forward for backward integration for the tiles manufacturing. But yes, the subsequent smaller segments, which has already, there is no product improvement scope. For example, tiles adhesive division, like the technological advancement in the tiles adhesive is stagnant. There is no new technological advancement. So whatever production comes into that particular industry, it is just about multiplying your dealer network, multiplying your customers and increasing your volume. And so we are planning to put up our tiles adhesive plant maybe soon. We'll get that announcement soon. And our natural stone division, it has the same service added benefit to the customer that we want to offer. We have recently started up with the Italian marble segment, the imported marble segment, in distributing to our end users for the high-end category of people. So in that product, the additional product benefit that we would like to give is maybe the cutting of marble, the repolishing of marble, and giving the exact size coordinates, which can give better margins, adding the labor cost. So yes, that division also we are going to have a backward integration soon. Its announcements will also come in soon after we buy the required machinery. It is under process. So
Thank you very much for the elaborate answer. So, I mean, how many contract manufacturers do we source from currently, and how easy is it to, I mean, like, if you see, like, some new technology, or how easy is it to switch to a new one?
So we usually do not switch over to new manufacturers who are already giving us steady supply and innovative products and colors and requirements are solved. But if there is a drastic change in the technological, in that particular size of product, then we look at the further expansion, but we do not replicate the product that we already have in our portfolio. We add on to the new technological product, which the existing supplier is unable to provide. Only then we tie up with the new one, and it is a win-win situation for everyone.
All right, so got it. My last question would be, how much CapEx would we be looking at in FY26, and would we be raising any debt for the same?
As in the figures are getting stable and constant, we would like to answer it in quantitative manner on a later stage. Currently, we are our accruals are good enough to accommodate the new future growth.
All right, sir. Thank you very much. Wish you all the best.
Thank you very much, sir.
Thank you. The next question comes from Aswath Rajan from Aryan Capital. Please go ahead.
Yeah, am I audible?
Yes, sir.
Yeah, thank you for the opportunity, first of all. So my first question is in line with slide number 28 in our presentation, which reads exclusive supply agreement with the government of Burundi. So could you elaborate on this agreement a little bit?
On slide number 28, you said, sir?
Yeah, it's 28, yeah. Our investor presentation.
Okay.
International.
So we have set up our so we are an affiliated member of Indo-African Chamber of Commerce, and they are kind enough to introduce us to newer governmental and newer African markets and required buyers in Africa. One of the opportunity that has come up from is as their economy is growing, they have a huge requirement for the infrastructure requirements. So we happen to meet the official team over their recent meetings in India, and also when my team visited them in Burundi. So they have a huge requirement. So we have tied up with them on a contract basis for requirement of supplying from project to project basis, like how we have been doing it in Uganda. Not adding on to our fixed cost, but on variable costs, covering their requirement. And that is how we have tied up with Burundi, not only with Burundi, but other country states as well, like Senegal, Sudan, in the similar manner. We officially appointed the required agents in that particular country to represent our company in their particular country, so that the introduction can be easier and the local person can trust the company since with our presentations.
Okay. So when it says exclusive type supply, does it mean that they're the only players who can supply to the government, or is it open for others?
So far, we have tied up with them on their approach from other tile suppliers has been less compared to our right approach from the chambers. And they have started to share their technical requirements as and when the new project is upcoming under the government supervision. And we have also started to supply in smaller quantities to their countries in Burundi at the moment. And there might be other suppliers for tiles, but so far the projects that have been coming through the government or the government channels, we have been supplying it to them.
Right. So how big is this market in Burundi? So is this very new at its nascent stage? The contract is very new, or do we expect? How is it? How's the nature of it?
So building up the relation with any country takes a few months in hand before they start trusting us. And our present, after their invitation here in our country, we show them our showrooms, our stock points, our presentation that is required for building their trust upon us, because we work in advanced payment mode with any African buyers. So their trust on us is utmost required. Once that trust is built after their visit, our team visits their country upon their invitation, and they help us meet potential buyers, different contractors, in understanding their technical specification. Once that is sorted and the requirement comes in, we start selling it to them.
Got it. Can we also say that, it's a different question. Can you say because of this oversupply in the market, are we a direct benefactor of this oversupply because exports have been an issue? So does this benefit us?
Sorry, I did not get the question. Can you rephrase it, please?
So we have this oversupply in Morbi right now, right? So do we benefit out of this oversupply? Do we get our products at a lesser cost because of it? Or
it depends upon the product size requirements. Like if it is an exclusive product range on premium size and bigger formats, then there is less of oversupply. And when we talk about running products wherein the volumes are maximum, yes, we do definitely get the benefit upon the payments. Like we get major discounts upon paying them in advance, or maybe they're overstocking of any particular design or model. Yes, we do get extra benefit of about 5 to 7% in when we have to buy it upon the stocks from them. But that is on a very less case because we focus majorly on the upcoming latest products. When we talk about the running product and production cycle, everything is already planned in advance before they go into maintenance and close down their production.
I ask you because, most manufacturers are facing quite an issue. So I'm assuming since you are not manufacturing and we source it, do we get any discounts on our buying price given the current scenario? Or has the price increased for you over the years? How has that trajectory been for you?
So yes, we do face technical issues when it goes into masses for everyone, not just the company as MCPL. When everybody faces the problem, it comes to all the buyers, may it be a contract manufacturer like me or even the manufacturer like Kajaria. So when it comes to MCPL, yes, we have seen significant changes in the industry in the past 5 years. And now we see that the stable constant is about to settle down very soon, because the added benefit of increasing the capacity of production that we are working with have all settled down and started to do a steady supply of product. It's just a time of maintenance of their plant, and it is only that tenure that the production cycle holds for at least a month. But the production requirement is always pre-planned. And when we talk about pricing benefit, yes, irrespective of every industry, the pricing is going up. Maybe if you go and buy a car or Honda City, maybe previously about 5-7 years, the pricing was about 10 lakhs, I guess. Today, the same Honda City is costing about 15 lakhs or 18 lakhs. But in our industry, because the innovative products and the production capacity altogether has improved, the manufacturers have either maintained the same price or reduced it down. But when the price have reduced, it doesn't reduce only for MCPL, it reduced for the entire industry, and we have passed on the benefit to the customer. Or when it has increased, maybe at the time of transportation strikes or any variable factors that has affected the industry, the benefit, the burden of extra new pricing, we have, if it was significant, if it was very small aspect, then we have absorbed it, or we have passed it on to the end user by minimum fragments.
All right.
But that is where MCPL comes into role picture, right? Like we can either absorb it or we can pass it on by minimum share, so that the end user or the customer is not heavily burdened up, or can also benefit with the price drop factor.
Understood. So now another question would be, so what is our ASP now, blended ASP in that case, and also if you could give us what is our average buying price for the same?
Buying price for the product?
So say we have an ASP of 100. What is our buying price of our product in this case, since we are sourcing it from someone else?
So if we are sourcing it up, if the end user goes and buys it up directly from the manufacturer, he can buy that same product for 105 or 107. Whereas MCPL can buy the same product with the volume requirement and the volume that we offer to the factory. We can buy the same product at 95 or 97, 98.
So you can buy it at 98 is what you're saying, whereas somebody else has to pay 107 for that.
105, 107, yes.
Okay, got it. All right, I have a few questions, but I'll get back to the queue.
Sure, sir. Thank you so much.
Thank you. The next question comes from Bhuvan MG from Tiger Assets. Please go ahead.
Am I audible?
Yes, sir.
Yeah, congrats on very good set of numbers. So I have a couple of questions. So you have mentioned about African expansion and Europe and US as well. So do you see any geopolitical risks and currency fluctuation risks coming ahead, and the Trump tariffs, all of these things, and any hedging strategies regarding this?
Bhuvan, thank you so much. It is a good point out for my international expansion team. When we talk about expansions into Africa, See, Africa is a growing economy. They require better quality products, and the high-end customers of Africa, they look forward to buying the same product from Africa, from Spain and Italy, because they are unaware of India's production capacity has got better and can offer better quality, unless and until we go and represent our products. So they get shocked as in, is this really an Indian manufactured product? So, and when we give them the transit time, which is less than the Spanish people and better pricing, we win on that case. When we talk about London, Europe, it is the same segment scenario wherein we are in competition with Spanish manufacturers, because even today, after these many years of experience, we have to turn over the tile to check whether it is made in India or it is made in Spain. We are that close in the finishing of the product. And when we talk about US is the biggest buyer for India. Even if Indian manufacturers sell 100% of their capacities to US or Latin America precisely, then we'll reach and we will satisfy their maybe 20 or 30% of their total requirement. So our expansion into these markets have always been very beneficial, first thing. Second thing, your geopolitical governmental interventions that is required. See, tiles manufacturing is an pollution generating industry. It is not something that is 100% economical or eco-driven like any other maybe people who produce maybe a cloth or something. I'm not sure. But so countries like US or Europe or cities like London, they like to just directly buy the finished goods rather than setting up their manufacturing plant in their own city. So we always have a better scope for selling it up to these exporting countries. When we talk about US in specific, the ongoing trade war, yes, our company has been established in the US currently, but because of the ongoing tariff wars, we have delayed our setting up of the store, because people there have either reduced on their imports or they are importing only to their exact current requirement. They are not stocking their material for selling it up in the future. So such kind of involvement, or maybe if the war breaks down on a massive scale or maybe there's a world war, then yes, the entire export market gets affected. Like recently, the transit time from the Red Sea, that was affected. So that the export pricing for the shipments had gone up by 3 times of sea freights. So at that time also we had India had reduced down on the exports for the entire tiles industry. But see, whatever happens for everyone in common, not just with MCPL. So, जो सबका अच्छा होना है, अच्छा MCPL का भी होगा, is what I always believe in. And whatever is affected, it is always the mass that will drive the force. But always make a note, like what MCPL had done in 2006. I'll just give a short brief. MCPL is always a risk taker. They always want to be ahead and always lead their position in the market. So in around 2005-06, India had imposed anti-dumping laws from importing tiles from China specifically. So major importers of India, they had withdrawn their new imports. But MCPL took a risk, and their first import was done from China with 2 containers, about 30,000 square feet of total product in Mumbai. Thinking that because it saw a gap between demand and supply. Today, when a person they want to import, or they want to use better quality product, they will delay their fund utilization capacity, but they will not cancel that entire event. So looking at that, when all the importers almost had reduced down on their imports, MCPL stepped into the picture and they still imported, looking into an idea of like, we'll sell this quantity in the entire year, MCPL could sell that product within 1.5 months. So new round of import was required and the cycle chain got established. So no matter where the product is being imported, where it is being exported, what government pressures, things get delayed, but they don't get cancelled. So even if tomorrow the American government imposes required tariffs for importing tires in US territory, things are delayed only till the extent of implementation of law. They will not be cancelled. The pricing that is going to go up, it will go up for everyone. And so will their per capita income, so will their expenses, so will everything else in the same manner. So things will be delayed and it will get better, but it will not be cancelled, is what I want to explain. If I can conclude to some answer to nearing to your question, sir.
Thank you for a very detailed answer, sir. I hope all the best for your endeavors.
Thank you very much, Bhuvan.
Thank you. The next question comes from Adarsh Singh from Equivalence Capital. Please go ahead.
Yeah. Hi. Very good afternoon, sir. So I have a couple of questions. So first is regarding the R&D spend. So the question is like how much of your R&D budget is allocated towards new product development? So this is with respect to high margin categories like large format tiles, quartz or sustainable materials. And like, are there any plans for setting up a dedicated manufacturing line for these premium products? So any color on this?
Okay. Thank you very much for the new round of question for the R&D. Yes, we do have the R&D department, which is an experienced team which is set up in Morbi itself, whose constant look is into searching out new manufacturers, new technological advancement that is going to come in the industry. So once the word is out, the new technology is still under the machine is still under import or are still under the manufacturing side. Our team approaches them and once the product is ready with the finished goods, we tie it up with them and we go ahead with the new purchasing. But when we talk about R&D with respect to manufacturing side, we do not have any team which does the raw material R&D. The raw material portfolio, MCPL has the capacity to buy finished goods, stock finished goods and sell finished goods, and not on the manufacturer side R&D. So that is the factories division and their work. It comes in there, the ball gets to their court. First they need to develop it up and present it before we start buying it up. When we talk about international travels and the requirement, so our team who is already present in, for example, every area, so they in turn talk to the end users, they in turn talk to the dealers for their current requirement, and they get back to the senior management for the new upcoming trend that is going to come up. Like for example, the buyer's capacity, the age group of buying. Previously it was 50 to 55 years. Today it is 35 to 40 years. New age group. That R&D is not very heavy investment requirement. It is a daily upcoming discussion that is always gets through the right things at the right time. And and any follow-up question upon this, Abhinandan, please?
No. So my question is not a follow-up question on this, but it's altogether different. So second question goes is like, I would like you to elaborate on how you guys select and manage manufacturing partners, and what are the systems in place to ensure consistent quality, timely delivery, and cost competitiveness across your diverse product portfolio. This is my second question.
Okay. So, see, this is a generational business and second generation of the product. I am more of a technical person. I am more of the person who looks at the demand side, supply side, technological side, what is requirement and what is the technical aspect to be required by the tie-up for the new manufacturer to tie up. But there is one very important element that we follow, and we have been following it up with over generations, and that is the values part. So that part is handled by the most valued person, or the person who values the values of the MCPL is my father, Mr. Manoj himself. So at the end of the meeting, he meets the manufacturers in understanding as to what their intentions are for the longer term. Over just one meeting, or with the experience that he has, or one meeting across the table with the manufacturer, with the owner of or the director of the manufacturing plant, helps us give the right picture as to whether we should tie it up with them or not. Talking about technical parts, we understand their technical aspect of production capacity. We understand their color pigments, from where they are sourcing their raw materials from, and the finished goods, currently where the product is being sold. Or does they have any complaints regarding the after-sales services that comes across. So based on these parameters, I finalize the new manufacturing tie-up. Apart from that, as I had previously told over the call, that we do not tie up with the new manufacturer if the existing manufacturer is able to supply our exact requirement. If we tie it up with only if the existing manufacturer is not able to give any advanced or new technological advanced products to us, only then we tie up with the new one. And these are the parameters that we are looking at tying up with the new manufacturers.
Okay, sure. And thank you. And my one more question is, just a second. Yeah. So with given the large capital outlay and your display system centers, warehouses, and export operations, so what's your framework for prioritizing investments across projects, and how do you measure ROC in these new ventures? Like, if you can give color on and elaborate on this.
Setting up any new division, setting up any new department or any new store, for example, will require a period of about 8 to 12 months, as I previously told. Post that, it is about just getting the profits out and increasing the volumes and margins. But initially, that is required from the actuals of current accruals or current working cycles that we have to maintain with them. When we talk about prioritizing our departmental, so currently my west and south zone, Maharashtra has been the oldest market for MCPL, and we are doing really well, touch wood, and we'd like to consistently improve upon that. Every store, every stock point can deliver the material up to 200 or 250 kilometers radius. And more of the stores that we are looking at are coming in India, which is in Nagpur, Pune depot, which is just now got operational and will get functional by next month automatically. And Dubai depot, that is a display center that is coming up, will be operational again in June. So our current focus is on the export segment and setting up the retail chain of networks. The retail chain of networks will give me better margins, and exports will give me better volumes as well as better margins, both of them. So this is where my priority is at the moment.
Okay, sure, sir. Thank you for your clarification. That answers my question. So all the best for future.
Thank you so much. Thank you.
Thank you. We have a follow-up question from Ashwat Rajan from Aryan Capital. Please go ahead.
Yes, thank you for the opportunity again. My question is, do we expect these 2 to 3% margin guidance from FY26 onwards, or is it for the years?
Can you please rephrase it again? Just skip the question.
I said, in our presentation, you've guided for 2 to 3% improvement in margins, slide number 30. So do we expect this from FY26 onwards, or is this for the years?
So that these improvements in the margins, that will happen over a period of time as and when the stores get older, the existing stores and the volumes get better. So we are expecting in financial year 27 onwards to better up on the margins. 26 is still a setup year. We still want to set up the US depot, we still want to set up the Dubai depot, and we also want to establish the other 2 depots that are coming up in Maharashtra, and the backward integration of other 2 smaller divisions that we are concentrating on. So once that happens, the follow-up year will have contributing better margins from these depots.
So what do we guide for FY26? What would be the margin rate?
Marginal rates for the net profits?
EBITDA?
EBITDAs, we would like to improve it when the stores start getting active. The London depot has just got active after the break-even this year. And as and when I said, so the EBITDAs will get better by around 1.5 to 2% this year around.
Okay. And for 26, how much we see our top line at? Ballpark?
The top lines, we will get back to you with that relevant information because this is too quick to respond as the new year has just begun.
No problem. And since it's, I mean, further down on the same slide, we see 20% guided for 20% on our top line in exports. Given the scenario in export is so cumbersome and so many players are trying to, many export players are not really doing well, how are we confident about achieving a 20% on our top line? Could you just elaborate on how the industry is right now and how we are going to put it forward?
So when we are talking about the improvements in the top line figures of the exports, I'm talking with respect to the numbers that are currently contributing. For example, I have achieved about 1.5 crore of business in the first year of exports in the year 2024, and we have already doubled up on the figures by 25. And that was the time towards the end of March, we started tying up with African new countries whose realization will start to happen this year. So that is 15 to 20% is something bare minimum of projection that we have made for this current year to happen. Because the markets like Burundi, that is just the first one that we, after tying up, we have started to dispatch our material. But there are other markets as well in Africa itself, like in Senegal, in Ivory Coast, in Uganda that we have already tied up with, the new projects that are coming up. So the relation has just got better. The relation has just started up. So this year onwards, we are starting to get their inquiries and we can get back to them.
Right. And on this 20%, does a majority chunk come from Africa, or is it the new markets that is mentioned? Is it Middle East, Europe, or does it come from Africa?
So African markets, we are planning to expand it through the Dubai depot because it becomes easier for the African people to travel in Middle East than to come down to India for their product selection or to do business with. It is easier for them to deposit the money in the Middle East market than transfer the relevant money in India. Because there they can also deposit their local currency in Dubai. Whereas in India, we only accept either dollars or pounds or euros, the ones which are famous. We do not easily expect the African currency locally in deposits in India. So the routing of African markets. Sorry?
Yeah, I asked if you could quantify this in terms of percentage. how much would the African market make? How much would the Middle East market make? And how much would it contribute to our top line? If you could just give us a number on this.
So all the Middle East, the African operations will be handled from the Middle East depot itself. So all the expansion figures that we are talking about will be routed through the Middle East depot itself. It is not a separate market for Middle East, and it is not a separate market for Africa. So African orders will be routed from our Dubai operations. That becomes easier for the African people to travel and get their selections done, because our industry, irrespective of how much technological advancement we have already improved, but still our industry, it is not like cloth. Like when we talk about cotton, when we talk about linen, when you talk about linen, you know how does it feel. When you talk about cotton, you know how does it feel. When you talk about polyester, you know how does it feel. Even to a layman. But when I talk about my industrial products or technical specification, like glossy, matte, but I'm sure you don't know how does a GHR finish feel like. You don't know how does a carbon finish feel like. You don't know how does soft satin feel like. So you need to have a basic feel factor. You need to have a physical store by the end of the day to make a perfect decision for buying your product into your home. And when you talk about physical presence, so physical presence is only driven by a physical store. So we need to be present over there. So African people cannot come down. They can come down, but less number of people travel to India than the chunk of people who are traveling to Middle East for any product selection, not only just oils.
All right. Got it. Thank you, sir. Thank you for answering my questions.
Thank you. Thank you so much, Ashwin.
Thank you. We have a follow-up question from Agastya Dave from CAO Capital. Please go ahead.
Thank you very much for the opportunity again, sir. So just one question. All other questions have been answered in quite a lot of detail, sir. So thank you for that. So the question is that, is there any chance, the inventory part, I understand you have to keep a lot of inventory, but is there any chance that we can see an improvement on the receivable side? Because that is sucking up a lot of capital. And I was just wondering, when will we become operational and free cash flow positive?
So currently we are still in the expansion mode and talking about the inventory days that we are trying to maintain. But by the month of February, we have incorporated, we have just introduced high-end natural marbles into our stock portfolio, which has increased our number of days of inventory currently by not a big number of days, but a marginal number of days. But when we talk about better days, we have improved from the March 24 to March 25 by more than a month in improving our collection ratios. Whereas when we talk about better margins, we are still in the growing stage. So as I told, like for upcoming by the next year or this year, towards this year end, we will have a better set of numbers. We'll have a better set of ratios to present.
All right. So one request, sir, and it's also, so you can take it as a suggestion as well.
Yes.
If you can start coming out with quarterly numbers, that would be very helpful. You need not have like proper numbers, but just like some basic write-up, a little bit of commentary about what you see during the quarter, and very basic numbers like what was your working capital days like, what was the revenue number, and how was the EBITDA and PAT number. That's it. 4-5 numbers will be more than sufficient, sir. 6 months is too large a gap, sir. It's very difficult to keep abreast with all the developments in the company. So all the qualitative and a few quantitative aspects, if you can share with us every quarter, like a 1 paragraph long press release would be more than sufficient, sir. Kindly consider it, sir. It would be very helpful and it will be greatly appreciated by everyone. Thank you very much for the opportunity, sir. All the best.
Sure, Agastya, I have noted down the request. I will definitely look into it, what best can be presented.
Thank you, sir. Thank you, sir. Really appreciate it, sir. Thank you, sir. All the best, sir.
Thank you.
Thank you. The next question comes from Jairaj Jain from Ashika Institutional. Please go ahead.
Yeah. Hello. Hi. Am I audible?
Yes, sir.
Yeah. Thank you for the opportunity. So this year, I have seen that your export has contributed to 1% of your revenue, and you have set a goal of 20% in next 3 years. So what specific product categories, markets, or partnership will drive this growth? And I know this is export, so how will you manage risk of currency fluctuation or trade regulation going on?
So currently, when we talk about 20% growth, I just recently been answered the same question, that we have recently tied up with different governmental organizations in various parts of Africa. We have appointed the agents who are representing our company as we speak, and we are looking at potential buyers for improving our top lines from the exports. And for them, we have recently set up a Dubai display center, which will be operational by next month, for them to have an experience center of the entire range of our products that we can offer to them. So, with this perspective, we are looking at a promising figure of improving. When we talk about improvements by numbers, the first year that we have exported in 24, March 24, were roughly about 1.1 crore in total revenues from exports, which we have already doubled up in the month of March, contributing to a significant number in that particular department. But when you compare it with the overall total sales, the percentage has come to 1.2%. But individually, when we talk about numbers, it has already doubled up. So looking at the same growth prospect, we have a much bigger scope to achieve this year, because the recent tie-ups that have happened has happened between Jan month to March month last year. So the receipt, the new tie-ups, the new collaborations results are starting to note recently. The new inquiries that have been starting to generate technical specifications, we are trying to attend to them.
Okay, thank you. And my next question is with a growing product portfolio and presence across multiple regions, how will you manage your inventory turnover and working capital efficiency as you will be entering into this export large scale with a longer cash cycle?
So we have tried to maintain the working capital with improving the top lines already, and we are looking at better figures and better numbers at this year end. And we are already working on it and delivering better numbers by March 26.
Okay. And given the large capacity outlay in display center and export operation, what is the framework for prioritizing investment across projects, and how do you measure return like ROC in this new venture?
So currently our focus is on increasing our investments and focusing on putting our investments and money in the export and the retail chain of stores for increasing our experience centers to the B2C categories, which can in turn turn over to our B2B categories in future. So our first priority is the export market, and the second priority is putting our investments in the retail chain stores.
Okay, and as you have mentioned, you will be opening a new office in upcoming months in Dubai. So what is the approach in attracting and retaining talent, especially in areas like design innovation, digital marketing, and international sales?
So digital marketing, the department is already started to work with the Google AdWords and promoting the company in various particular areas. The digital market has not yet opened up for the store for Dubai, because if that is set up, if the customer wants to have a look at the store, till the time we are not yet ready, we have not yet focused on digital marketing on a single rupee budget for Middle East yet. Till the time the store is physically functional. So once it is set up, we can move on. We can have a kickstart.
Okay, great. Thank you for answering all my questions.
Thank you very much.
Thank you. That would be the last question for the day. Now I hand over the floor to the management for closing comments.
So I thank everyone and all the participants and lovely set of audience for listening to all our questions, and I'm happy to answer all of the answers, and also beyond this call, we are happy to help. Confideleap partners are our IR representatives, and we would like to connect. If anybody can connect with them for any further questions, and we are happy to answer all of them. Thank you very much for this conference call, and thank you very much for all of you to attend this and give this opportunity to present our company on this platform. Thank you very much, team.
Thank you, sir. Ladies and gentlemen, this concludes the conference call for today. Thank you for your participation. You may disconnect your lines now. Thank you and have a good day.
Thank you very much, sir. Thank you.
Sir.
Bye-bye.